You save your first $20,000 and something shifts. Not because you're rich, you're not, but because money stopped working the way you thought it did. Most people never notice this. They hit 20 grand, feel proud for a week, then watch it sit there. Same savings account, same 0.4% interest, same financial life, just with a bigger number on a screen. But here's what they miss. At $20,000, you cross an invisible threshold where the entire financial system starts treating you differently. Not dramatically, not obviously, but if you know where to look, the rules change, the options multiply, and the gap between people who understand this and people who don't begins to widen at a speed that's almost unsettling. This isn't about motivation, it's about math, and the math gets strange after $20,000. Let's start with what $20,000 actually represents in the current American economy. For context, the median household savings account balance in the United States is roughly $8,000. The median. That means half of households have less. So if you've scraped together $20,000, you're already in the top third of savers in the country. Not wealthy, not comfortable, but statistically doing better than most. The Federal Reserve conducted a study in 2023 asking Americans if they could cover an unexpected $1,000 expense without borrowing money or selling something. 37% said no, they couldn't. Another study from Bankrate found that only 43% of adults could handle an emergency expense of $1,000 from savings. So $20,000 feels like a fortress compared to that. It is a fortress compared to that. But it's also the exact dollar amount where traditional savings stops making sense and where the financial industry starts whispering different offers in your ear. Here's why. When you have $5,000, your options are simple. Checking account, savings account, maybe a high-yield savings account if you're paying attention, earning 4 or 5% annually. That's it. The system is linear. You save, it grows a little, you keep saving. But at $20,000, the invisible menu appears. This is the point where banks start sending you emails about brokerage accounts, where investment apps stop showing you the basic interface and start teasing portfolio options, where credit card companies pre-approve you for cards with benefits you didn't know existed, where suddenly a 0.4% return feels insulting instead of normal. Because here's the thing. The opportunity cost of doing nothing with $20,000 is now measurable in ways that sting. Let's say you leave it in a standard savings account earning 0.5%. After 1 year, you'll have $20,100. You made $100. Congrats. Except inflation ran at 3% that year, which means your money lost $600 in purchasing power. You went backward by $500 while doing exactly what you were told to do. Save responsibly. Now let's say you move that same $20,000 into a high-yield savings account at 5%. No risk, FDIC insured, just a different bank. After 1 year, you've got $21,000, $1,000 for free, just for opening a different account. That gap between $100 and $1,000 is the cost of not knowing the game changed. And that's just the beginning. At $20,000, you also become eligible for something most people have heard of but never actually experienced: a real brokerage account with real minimums waived and actual investment options beyond a robo-portfolio. This matters because of compounding, not the inspirational poster version of compounding, the ugly, slow, boring version that actually works. If you take that $20,000 and put it into a diversified index fund, historically returning around 10% annually, and you never touch it for 30 years, you'll have $348,000. No additional contributions, just time and math. If you leave it in a savings account at 1%, you'll have $26,000. That's a difference of $322,000 for doing nothing except choosing a different box to put the money in. But here's where it gets uncomfortable. Most people don't make that choice, not because they're dumb, but because the financial system is designed to keep money where it is. Inertia is profitable. Your savings account pays the bank more than it pays you. Your unused cash sitting there lets them loan it out at 6, 8, 12% while you collect crumbs. And nobody tells you this. There's no email that says, "Hey, you just crossed 20,000. The game is different now. Here's what you need to know." You're supposed to figure it out yourself. But let's say you do figure it out. You move the money, you open a brokerage account, you buy index funds or ETFs or treasury bonds or whatever makes sense for your risk tolerance. Now you've done what financially literate people do. But even here, the system has layers you don't see yet. At $20,000, you're still too small for private wealth management. You're still getting the same customer service as someone with $2,000, but you're big enough to be targeted by every fintech app and robo-advisor trying to scrape a percentage off your assets under management. 0.65% annually sounds like nothing. It's just $130 on $20,000. But compounded over decades, that fee is tens of thousands of dollars transferred from your future net worth to their quarterly earnings report. Meanwhile, people with $2 million get private bankers who call them by name and offer fee waivers and structured products you've never heard of. The system is tiered, and $20,000 is just barely inside the door. Here's something else that shifts at $20,000: your ability to take strategic risks. This is subtle but important. When you have $2,000 saved, you can't afford to lose any of it. Rent is next month, car insurance is due, your emergency fund is your emergency fund, period. You can't gamble, you can't speculate, you can't even invest in anything that might drop 30% in a bad year because you might need that cash tomorrow. But at $20,000, if you're living below your means and you've got stable income, you now have enough cushion to take intelligent risks without jeopardizing your life. This is where people start businesses. This is where people buy rental properties with FHA loans. This is where people put $5,000 into a Roth IRA and another $5,000 into learning a high-income skill and another $5,000 into an S&P 500 index fund and keep $5,000 liquid. They're not risking everything. They're diversifying across both assets and opportunities. And that only works when you have enough capital to divide intelligently. $20,000 is the smallest amount of money that can be divided into meaningful bets without becoming irrelevant. $5,000 can't do that. $50,000 can do it better, but $20,000 is the threshold. Now let's talk about debt. If you have $20,000 and you also have credit card debt at 22%, you are making a catastrophic mistake by not paying it off immediately. This sounds obvious, but millions of people sit on cash while paying interest on revolving debt because it feels safer to have money in the bank. It feels like progress. It feels like you're winning. You're not. If you have $10,000 in credit card debt at 22%, you're paying $2,200 a year just to keep that debt alive. That's $200 a month evaporating into interest. If you pay it off with $10,000 from your savings, you instantly earn a 22% return, guaranteed, risk-free. No investment on earth offers that legally. But people don't do it because debt feels like a separate problem from savings. It's not. It's the same system, and at $20,000, you finally have enough leverage to eliminate high-interest debt and still have a safety net left over. This is the move that separates people who stay stuck from people who break free. Let's shift to something weirder: credit. At $20,000 in liquid savings, your credit profile starts to change even if your score hasn't, because now you're bankable. Banks don't just look at your credit score, they look at your assets, your debt-to-income ratio, your liquidity. And when you apply for a mortgage or a car loan or a business line of credit, the person underwriting your application sees that you have $20,000 sitting in an account. That changes their risk calculation. You're not just a score anymore. You're someone with reserves, someone who can weather a missed paycheck, someone who's less likely to default. So your $20,000 isn't just $20,000. It's a signal. It's proof. It's leverage in a system that rewards people who already have money. Which brings us to the darker part of this. Everything we've talked about so far, opening a brokerage account, paying off debt, improving credit, these are all things that only become obvious if you're already financially literate, if you've read the right books, listened to the right podcasts, had the right conversations. But most people don't. Most people who scraped together $20,000 worked brutal hours to get there. They sacrificed. They saved aggressively. And then they stop because nobody told them what to do next. They leave it in a checking account. They let it sit. They feel accomplished, and they should, but they don't realize the finish line moved.
Because the financial system doesn't reward effort, it rewards knowledge, and knowledge is distributed unevenly, quietly, and often along class lines that nobody wants to talk about. So yeah, $20,000 changes everything, but only if you have it, and increasingly that's entirely the problem. The system is designed to reward people who've already won, and punish people who are still trying. You can call that unfair, you can call it capitalism, you can call it whatever you want, but it doesn't change the math. And the math is the only thing that matters.